But when you're doing a no upside risk iron condor, to have no risk to the upside, you have to think of it as if you're not receiving any premium. You didn't receive this 192 here. You put this on and your risk is completely $500. Well, let's talk about the no upside risk iron condor because we've been in a bull market and to some of our chagrin, this market is continuing to go up, but you have to play the cards that you're dealt and you can't be dogmatic and say, I know it's going down today or I know it's going down this week. If you're dogmatic about things like that, you can be carried out on a stretcher in these markets, right? Because the last 3 months have been up 35+%. We off the lows. That is brutal if you were just being dogmatic about being short the whole time because you're listening to news and news is trying to give you all the bad things because that's how they get viewers. And you're like, no way can this market continue to go up. It's got this, and that going on in the economy. Well, it's going up, and it has. So with that said, if you want to have a kind of a bearish type of component to your trade, but not get ran over to the upside, you can do a no upside risk iron condor. I'm going to use the SPY to be able to show this. All right, so if we go over here and I want to break this down in two ways. The most important way is understanding the call side of the no upside risk iron condor. When you do a traditional iron condor, you have risk to the downside if it goes down too much, or you have risk if it goes up too much on the call side. When you're structuring a no upside risk iron condor, it starts by how you set up the call side. So if I go here and I just say, I'm going to sell this 35 delta. I usually want to be at around the 30, but I just go with this 35 delta here. I sell this 35 delta call spread. When you're doing a call spread, when you're selling it, the most you can lose is based on the width of the spread. So this is a 5-point wide spread and it's $100 per point for stocks. So it's 5 times 100. The most you can lose here is $500 if it went up and you were only doing this bear call spread here. If you're only doing this. Obviously, you have to minus the premium that you receive as well. So if you minus the 192 here, as you can see, TastyTrade is giving you, your max loss on the call side is 308 if you were just doing a bear call spread. But when you're doing a no upside risk iron condor, to have no risk to the upside, you have to think of it as if you're not receiving any premium. You didn't receive this 192 here. You put this on and your risk is completely $500. So to have no upside risk, you have to collect more than $500. So if you can lose $500 to the upside, you have to collect more than that. So in this case, let's just say we were receiving, it's 192, but let's just say we were receiving $200 here. Well, we would have to receive over 300 on the put side to make sure we're receiving a total amount more than the 500. Because as you can see here, if you just do the bear call spread and you go to this curve view, you have risk if it goes up. This is the at the money line here. So if it goes up, you have risk. You can lose. You want it to go down, this is how you can win. Before we continue with the video, I just want to quickly point out, if you need any additional help, please consider joining our trading club. You can do that by clicking on the link in the description area, and you'll get a 3-month trial for a flat fee of $60. We look forward to seeing you in the trading club. Back to the video. If we go and we put on the bull part of the no upside risk iron condor, and I just say we sold at this 15 delta here, and I'm just going to do this here, and I just say we did a 10-point wide spread here. So we are collecting total here $269, $270. So if you go back and you look at this curve view, you're going to see, if I make this bigger, you're going to see that we have risk just like a traditional iron condor. This is just like a traditional iron condor. We have risk to the downside, which is in this direction we can lose. This is going down. And then you can see we have risk to the upside if it goes this way. This is going up. The only way we win is this traditional iron condor here, is that if it stays in between the short legs, this is our win zone here. Because we're not collecting more than what we can lose on this call side. Once again, we can lose $500. So to be able to do that, you got to figure out how to collect more on that put side. So you can decide to do that by adding more contracts. So if I added, let's say I added 4 contracts, 1-to-4 ratio, Well, if I getting 105, it's not a lot because you got fees and commissions, but before fees and commissions, you're going to see that this curve view has changed. Now you can see that it's showing winning going to this direction here. Right? And it's showing the only way you can lose. This is the at the money here. If it goes down too much, this would be your loss zone. Obviously, you still want it to stay in between because this is where you can make the most of your money at in this area here because it's still an iron condor. It's still inherently neutral, but you're structured it in a way that you do not have any upside risk. I don't love this right here because you're only getting $5. If it goes up, you would only win $5 and you would have to go all the way to expiration and still wouldn't win that because you got fees and commissions. So I would either have to make this wider or add another contract to make this more attractive, or I would have to go to a higher delta. Here at Dorian Trader, we like to start off our risk areas no higher than a 15 delta, so we can have at least an 85% chance of winning. You can see that TastyTrade is saying we have an 87% chance of winning on this trade at this point. I just go by these deltas here on the risk side, and so 15 and minus that from 100, that's going to give me the 85% chance of winning at expiration. But I don't like not having more money. So if I did 1-to-5 ratio, then this is better. So if it goes up all the way past the call side, I'm still going to win, $75, $80. And it's requiring a buying power here of about $4,400. It's not horrible, but this is the way it would play out using the SPY. If I decided that in just this case, I wanted to go a little wider, excuse me, not a little wider, but a little higher on the delta. So let's say I decided I was going to go all the way to the 20 delta here and still have, a decent 80% chance of winning. And that's still a 5-point wide spread. I mean, excuse me, a 10-point wide spread again. So now you can see we're collecting 700. So we can still make 200 before fees and commission to the upside if it goes completely past the upside. So if we can just show you here, it's on the curve view here. Now you can see here, and then if I go to this analysis view here, you'll see how this kind of plays out. And I'm gonna remove something. I think I got an SPY trade here. Let me see overview where it is at right here. So let's do this. Remove that, move this. And so now you can see that we can make the most if it's staying in this range here. As you can see here, if it stays in this range, this is the inherently neutral type of iron condor. If it goes past the call short leg, this here, then we start to lose some of the max we can make, but we still win. And this is going to be $200 regardless as it goes up. If it goes down a lot, that's the only way we can lose. And we have $4,300 of risk to the downside. Obviously, we won't allow ourselves to lose that amount, but that's the risk technically with this trade is $4,300 to the downside. This is a pretty good return on your capital on this trade because what do you have? We're collecting 700, right? And you divide that by the 4,300, and you get 16% return on your capital, a little over 16%. Here at Dorian Trader, you guys know we want to try to get, for a standard trade of ours, we try to get at least 12% return on our capital. So this works. It's not bad at all for this trade here with 56 days to go. And you're doing a no upside risk iron condor. So if the market goes up still, but not a lot, you got a potential to win 700. If it goes down, but not a lot, but you got more room to the downside, you're still going to make $700 on this trade here. No upside risk, iron condor. This is how you structure it. This is how you get some type of bearish component. But if the market continues to do what it's done over the last 3 months, you're still going to make money. So if you put this on at the end of April, you would have still made $200 if you let it go to expiration. Even though we don't do that here at Dorian Trader, but just for example, if we let it go to expiration, we would have made $200 still.